Welcome, G traders. You are watching a recap of the Asian trade on July 4 with me, Kate Stichina. Asian stocks slipped on a Tuesday, whereas the US dollar and the crude oil moderated their sharp price swings. Investors are unnerved but try to take a cautious approach, awaiting fresh signals about further policy moves of major central banks. The Reserve Bank of Australia decided to hit a pause button in its policy meeting today. The policy update defied expectations of another rate hike by 25 basis points. July could be a volatile month because investors cannot predict the rhetoric of the Federal Reserve and other central banks for the coming months. The Asian markets traded quietly ahead of the celebration of Independence Day in the United States today. So, most Wall Street investors will take a break. US stocks included in the S&P 500 edged down by 0.1% in the Asian session. Most Wall Street indexes closed the short New York session in the green, accompanied by growing yields of US Treasuries. Investors will closely monitor economic data ahead of a new season of corporate reports for the second quarter. Another vaguer issue for investors is the Fed's agenda for further monetary policy. The minutes of the Fed's latest policy meeting will be available later this week. Hence, investors will find clues to further policy moves. The minutes are sure to shake the markets. If the US Central Bank decides to increase interest rates more than twice, as predicted by markets, the recession risks will escalate considerably. On a Monday, the yield curve of US Treasuries suffered the sharpest inversion since the time of severe inflation when Paul Volcker ruled the Federal Reserve. It means that financial markets are worried that protracted rate hikes could eventually push the US economy into recession. Geopolitical tensions are also taking their toll. China imposed restrictions on exporting certain metals that are crucial to parts of the semiconductor, telecommunications, and electric vehicle production. The ban worsened the trade war with the United States, threatening to cause serious disruptions in international supply chains. Companies have already responded to the news announced on Monday. One of the American semiconductor manufacturers immediately said that it would apply for export permission, willing to calm down investors. A Chinese germanium producer told Reuters that foreign orders and its shares soared on a Tuesday. China's Commerce Ministry stated that from August 1, it would control exports of 8 gallium and germanium compounds with the aim of safeguarding its national security and interests. Analysts are certain that Beijing responded this way to tough moves of Washington intended to curb China's technological advance. The US dollar index traded steadily on a Monday and in the Asian session today. However, it broke the level of 103 points upward as investors evaluated the US red-hot economic data and the prospects of the Fed's further monetary tightening. The economic calendar this week contains the US nonfarm payrolls, JOLTs, job openings, and the ISM non-manufacturing PMI. The focal point will be the minutes of the Fed's meeting in June. Last week, Fed Chairman Jerome Powell confirmed that the central banks would go ahead with more rate hikes until the year end. While such prospects benefit the US dollar, at least the greenback is staying afloat against a basket of 6 major rivals. What fundamentals will set the stage for the US dollar's weakness? Inflation data has to prove easing inflationary pressure. The CPI for June will be released next week. Meanwhile, the US dollar index is standing tall, not far away from the weekly high of 103.54. If this level is broken, the index could climb to 104.70. Nevertheless, the longer-term outlook for the greenback is bearish. The yen is extending its weakness amid the rumors about forex interventions. The Japanese currency weakened to 144.70, and this protracted bear trend has been going no as traders refrain from opening large bets amid comments by Japan's key currency strategists. He indicated that Japan's authorities are engaged in the talks with the U.S. Treasury Secretary Janet Yellen and other foreign partners. The talks concern the forex situation and broader finance-related issues. Japan's finance minister acknowledged this information without detail. He also warned of the risks entailed by excessive selling of the yen. The yen has got stuck at its 8-month low, close to the landmark level of 145. Last year, Japan's monetary authorities ventured into forex interventions when the yen slumped to that low. The yen's protracted weakness has been going on amid statements by Bank of Japan Governor Kazuo Ueda. He said that there is a long way ahead until inflation is brought down to the 2% target, bearing in mind that wages should also grow at an acceptable pace. With such rhetoric, the Bank of Japan stands out among other central banks, including the US Fed, the ECB, and the Bank of England. All of them signal more rate hikes this year. The support of the dollar-yen pair is located at 142.22. Its breakout could undermine the bearish bias, but ideally the support should withstand. The Reserve Bank of Australia maintained the interest rates unchanged at 4.1% at its policy meeting today. The bank needs more time to assess the impact of the previous rate hikes. The central bank raised the cash rate by 25 basis points in June. All in all, the interest rates have increased by 400 basis points since May 2022. The central bank noted that inflation in Australia had passed its peak. The CPI slowed down to 5.6% in May from a month ago. Still, the bank admitted that inflation remains at elevated levels. The CPI came in at 7% in the first quarter of 2023. Inflation is likely to remain at this level for a long time. Hence, the central bank found it appropriate to proceed with the money tightening in an effort to bring inflation down to the target range of 2 and 3%. All decisions will be adjusted to further economic data and inflation dynamics. On the top of that, the Reserve Bank of Australia said that it had been keeping track of global economic trends, household spending, and inflation forecasts. The stance of the Reserve Bank of Australia matters a lot to the Australian dollar. If the regulator makes a hawkish decision, it improves the luster of the Aussie for investors seeking for higher yielding assets. In turn, the Australian dollar gains ground. Alternatively, a dovish decision takes the shine off the Aussie. Judging by the Aussie's response to the interest rates decision, traders grasped dovish notes in the policy statement. Following the central bank's decision, the AUD-USD pair dropped by more than 40 pips, below 0.6650, but then rebounded. The resistance is seen at about 0.6665. If this level is broken, the price could slide to 0.6465, and this move matches the bearish scenario. Conversely, strong growth and a breakout of 0.6715 will assure traders to revise the forecast from a bearish to bullish, so the price could carry on its climb with a target of 0.6965. The New Zealand dollar traded higher in the Asian session. It gained 0.4% before the policy meeting of the Reserve Bank of New Zealand. The central bank is widely expected to raise interest rates next week to tame stubborn inflation. And the business sentiment survey showed the moderation of pessimism in New Zealand. 59% of the companies predict that business conditions will worsen versus 63% in the previous quarter. Besides, consumer sentiment improved to the 17-month high in June. It might indicate robust consumer spending in the coming months. Investors also anticipate the US non-farm payrolls and the minutes of the Fed's policy meeting, and they will provide clues to the Fed's agenda for further policy moves, although the New Zealand dollar will be sensitive to these factors in the near days. Keep close tabs on financial markets on the InstaForex TV channel. We care about your profits. Stay tuned with us.